The cream she puts in her coffee, he helped make. And because she chose that cream, he gets something back for his hard work. The yogurt he enjoys every morning, it all started with her idea that so many worked tirelessly to perfect. Because behind every great product is a person, and another, working together to create something real, pure, and impactful. And behind each and every one of those people is this mark. We are Dairy Farmers of America, and our mark ignites our passion, empowers our vision, and stands for everything that matters to us. Like our products, from a glass of cold milk to the perfect slice of cheese, we proudly make each one with integrity, innovation, and passion. Like our people. From our thousands of dedicated family farmers who put their heart and soul into everything they do from sunup to sundown. To our talented employees who work non-stop with customers, farmers, and families to bring the simple pleasures of real dairy to tables around the world. And the millions of families who sit at those tables, the ones who enjoy, share, and love what we create. They all matter to us. This mark matters because it brings it all together, from farm to table and everything in between. This mark matters.
Farm Credit supports rural communities and agriculture with reliable, consistent credit and financial services in good times and bad. We provide loans to farmers and ranchers, farmer-owned cooperatives, rural homebuyers, agribusinesses, and rural infrastructure providers. As cooperatives, we're locally owned and governed. We help agricultural producers feed the world. For America's farmers, Farm Credit supporting rural communities and agriculture. Learn more today.
CalBio built a digester that fits into dairy operations and enhances manure management. Our digesters help the industry meet California methane reduction goals while creating a new revenue source for the dairy. The projects also help build the message to the consumer about the role of California dairies, leading the way on sustainability. CalBio is working with over 60 San Joaquin Valley dairies to build digesters. Reach out if you would like to learn more.
The day can wait. Enter the Golden State with real California dairy.
Stueve, President of the California Creamery Operators Association. I'd like to welcome you to the association's 121st annual meeting. We're especially glad this year to have you join us, even if it is virtually. Last year, for the first time, we found it necessary to cancel our traditional meeting in South Lake Tahoe due to the obvious concerns related to the COVID-19 pandemic. But CCOA's purpose is just as important today as it was in 1900, when creamery operators united to help one another keep up with the fast-paced societal changes. And there's still much value in coming together today to communicate and collaborate on the unique challenges we face as a dairy industry, especially here in California. Needless to say, the past year has been challenging. We've been challenged both professionally and personally, as almost everyone's lives have been disrupted in some way. And the dairy industry is no exception. We experienced the challenges of marketing through lockdowns, interruptions in supply chain, the almost complete shutdown of the traditional food service sector, an extremely important part of dairy's marketing efforts. We experienced demand swings like perhaps we've never seen before. We endured strong price volatility due to COVID, which affected every sector of the industry. So what a year it's been. But I've never been more proud to be part of this extremely resilient industry. Throughout it all, dairy producers, dairy processors, and the entire dairy supply chain committed to giving back to their communities, supporting food banks and feeding programs, whether it was through milk and dairy product donations or just volunteering. This industry stepped up like perhaps never before. And of course, it was all done while each one of us personally endured the challenges of COVID and did our very best to keep our families, our coworkers, employees, and ourselves as safe as possible. And in this June Dairy Month, the industry has once again stepped up and recommitted to the community and to the planet. I wouldn't say that there was a silver lining to something as awful and tragic as the pandemic, but I was encouraged to see, especially at the beginning of the pandemic, consumers flock back to dairy. They couldn't get enough. Store shelves were empty because they knew that unlike anything else, dairy would provide them and their families with the powerhouse nutrition they needed, they wanted, and importantly, they couldn't get anywhere else. And even though that situation understandably didn't last as supplies began to smooth out over time and new routines were established, even those of us in the industry were reminded just how important dairy really was and really is. So that being said, it's our challenge now to build on the good things we learned through this awful COVID experience and come away motivated and committed to being better on the other side. Appropriately, our theme for this year's program is titled Innovation in an Era of Evolving Challenges and Opportunities. Because one thing is for certain, we're going to continue to see change that requires innovation, and this change and innovation will surely come at a more rapid pace than we have ever experienced before. And that innovation won't just be the typical changes to consumer products and packaging, but equally, we're going to need to innovate in just how products are produced and how to best use the planet's resources in bringing these products from farm to consumer. Over the next few days, we'll explore these opportunities, but also look at the many challenges that face the California and the Western dairy industry. So again, thank you for joining us today. We have some really terrific presenters and panelists, true leaders in their fields. I'd like to personally thank them for participating. These are folks that you're definitely going to want to pay attention to. I'm certain you're going to enjoy the program over the next 3 days. Additionally, this event would not be possible without the support of all of our members and sponsors. I especially want to recognize our top-level sponsors, the California Milk Advisory Board, California Bioenergy, California Dairies Incorporated, Dairy Farmers of America, Dairy America, Farm Credit, Hydrite Chemical, Hilmar Cheese Company, Producers Dairy Foods, Calgren Dairy Fuels, Clover Sonoma, Crystal Creamery, Moss Energy Works, Saputo, and Valley Milk. On behalf of myself, the entire board of directors, and all our members, I again like to welcome you to the CCOA annual meeting, and I look forward to seeing all of you in person next year when we return to South Lake Tahoe on June the 27th and June the 28th. So now it's my pleasure to introduce our first speaker, Phil Plourd. Phil is president of Blimling and Associates. Phil's been a past and frequent contributor to our program and is familiar to many of you. Please welcome Phil Plourd as he offers his expertise and insights on dairy's economic outlook. Phil?
Thank you, Gary, and thanks for having me today. If I was truly honest, I would say that these virtual meetings, some of them have been just fine. I have not minded skipping, say, Fargo in February to do something virtually from my basement office here in Madison, Wisconsin. I will say, though, that the opportunity to go to Lake Tahoe every year and interact with the people at the Creamery Operators meeting has been a career, one of those highlights of my year over the course of my career. So it is a little sad to have to do this from my basement and not from the shores of Lake Tahoe, but really do appreciate the opportunity to speak with you today and offer some thoughts on where we are in the dairy market universe and where we may be going. As a reminder, and I think this will be true throughout the day for folks, if you have any questions, we'll get to those at the end. If you would just use the chat button, chat feature on this platform, we will have the questions, and I will attempt to answer them at the end of my time as we can. So with that, I think we'll get started and get into it. And I think that today I would like to start with good news. It's not always as expected. It's not always evenly distributed or evenly patterned out. But as this graph shows, U.S. per capita dairy consumption on a milk fat basis continues to rise. Now, USDA's data, we don't have 2020 yet. I suspect that 2020 will be another year of growth. But you can see, as a general rule, the trend line is moving from the lower left to the upper right of this graph, where we've gone from about 540 pounds per capita in 1975 to about 650 pounds in 2019. And so, oftentimes we read the stories about the death of dairy and all sorts of problems. And there are certainly issues in segments of the industry for sure. But on balance, in the United States today, we are consuming more dairy products per capita on a milk fat basis than we had been 10 years ago, 20 years ago, 30 years ago, et cetera. So that's good news. The other piece of good news is that, I skipped ahead one, or my slides got out of order. No, okay. Another good news piece is that per capita cheese and butter consumption remains strong. And that cheese has really been a driving force in that big per capita number. Per capita cheese consumption up 1.8% on a compound annual basis from 2010 to 2019. That's actually accelerated from the 2000 to 2019 pattern. And butter's at plus 2.5%. And also, exports of powder and cheese have tripled over the past 15 years. So the first graph on the left gives you some flavor around that per capita growth that we showed on the previous slide. And the export story has also been a generally good news story for the U.S. dairy industry. Another thing I find just unbelievably remarkable and just shows how dairy producers are innovating much more than we think, or much more than some people give them credit for. We are unbelievably growing in terms of productivity. Milk per cow per day, going back to 2007 is what's on this graph, and we see the high and the low every year and the annual average. And so far this year, with 4 months in the books, 5 months in the books, we're averaging 67.1 pounds of milk per day per cow. But what's remarkable about this, if you look at last year, the low number from last year was actually higher than the high number in like 2014, 2015. And so we are continuing to get more productivity out of cows, which I think has economic benefits. I think it has environmental benefits. And it just shows how the U.S. dairy farmer is really aggressive in terms of growing their business in ways that, I think at some point you say, well, how much more milk can we get out of a cow? And I don't think we've answered the question yet, because the trend here is pretty clear. One other kudo to U.S. dairy producers. The market has told dairy farmers that fat is valuable. If you look at the past, if you look at 2014 to 2019, in each of those years, we saw the price of butter up above $2 per pound on average. And so dairy farmers, that market was telling dairy farmers, hey, fat is valuable, make more fat. And dairy farmers have responded in amazing ways. Last year, the average fat test in the U.S. was at 3.9%, 3.91%. And that compares to 3.67, 3.74 not too long ago. You think, it's just a few hundredths of a percentage points. But that when you spread that over, 220 billion pounds of milk, these small, what seem fractional increases in fat output are quite impressive in terms of additional poundage. When we look at other mega trends before we get into the here and now, we have fewer cows. We used to have, not so long ago, 1950, I guess it was a while ago, we had 21 million cows in the United States. That number's flattened out to somewhere between 9.3 and 9.5 million cows over the last several years. But we have fewer farms in the U.S., down by an average of 3,800 annually, which is minus 6% on a compound basis since 2000. Average herd size from 2000 to 2020 has gone from 88 to 297. So that's this graph here. So fewer operations, bigger farms. And when you look at California specifically, California has 48,000 fewer cows than in 2011 and 460 fewer operations. So part of the whole evolution of the industry nationwide has been this trend towards fewer operations, more cows per operation. And that number, that has been true every year since the early 1970s and really largely since the 1950s. And we make a lot more milk today with the same number of cows that we had basically 20, 25 years ago. Again, pretty amazing stuff. Let's talk about market volatility for a second. The U.S. dairy market is among another place where we overachieve. Is that the U.S. dairy industry is among the more vulnerable and volatile commodity markets globally. You can see this class 3 milk graph going back to 2000, quite a bit of movement. When you look at the actual calculation of price volatility, last year was unhinged in terms of what we saw in the marketplace. This year has been relatively calmer, has been somewhat calmer, but still high by historical standards. And when you look at dairy versus other markets, I kept crude oil off this chart because crude oil blew the scale last year. But when you look at this chart, you can see barrel and block cheddar cheese and butter rank, just below lean hogs and natural gas in terms of overall market volatility, and ahead of coffee, ahead of the S&P 500, ahead of corn, ahead of non-fat dry milk, ahead of gold. So our dairy markets are quite volatile, and that creates challenges that we'll talk about in a moment. Okay, so let's talk a little bit about the here and now. We are in a period where prices have been sagging. The cheese market has been hanging out in the 150 area. Butter has been about 170. Powder kind of near $1.25. Futures for the next 6 months as of Friday, 1750 class 3, 1650 class 4. I would say that those are average to below average prices. And so you can see, there was some better cheese pricing earlier for a little bit in the late part of the first quarter, early part of the second quarter, but we slid down. Butter sideways, non-fat sliding a little bit. So we have seen a little bit of devaluation on the commodity side of things over the past several weeks. And we could pretty much stop the presentation right here if we were wondering about why, because we have seen a significant increase in milk production and most notably a big increase in cow numbers over the past several months. I think cow numbers have been up 11 or 12 months in a row. The May milk production report showed the herd up 5,000 from April and up 145,000 year over year. That year over year gain in cows was the biggest since 2008. So we have had a period of pretty impressive expansion here in terms of cow numbers. The graph on the right shows you where Texas leading the league. Just for your information, California is actually slightly negative year over year in cow numbers. But we see a lot of growth in the Midwest and sort of the Plains area and Texas. And not surprisingly, more cows have meant more milk. U.S. average daily milk production was up 4.6% year over year in May. Now, that was against a soft 2020 number, but we've been running pretty consistently 2.5% to 3% higher. And productivity gains are strong with milk per cow per day at plus 1.7% over the past 12 months. That compares to plus 1.1 for the previous 12 months. So we have more cows. That's helping us get more milk, and we have more productivity, which is also helping us get more milk. And just as a general price comment, historically, when we have more than 100,000 cows over year prior levels, we don't see especially high prices over the next 6 to 12 months. Before this April, we had 15 months historically with cow numbers up by that margin or more. And class 3 was lower in the subsequent 6 months, 14 to 15 times, and 12 months average was lower, 15 to 15 occasions. And right now, we are in the plus 145,000 area. So you can see we're somewhere over here. And if you look at the next 12 months of pricing, the average has tended to be 15, 20% or more lower than year prior levels. So that's just something to keep in mind, that we have a lot more cows. That means more milk, and it's going to take a while for us to get past that. We do have higher corn prices, though, which are making things interesting from a margin perspective. Nearby corn is back to 650 after visiting 750. The December corn, new crop corn contract has been crazy. Since March 1st, it's been between 450 and 638. It closed at 519 on Friday. I just looked a few minutes ago, and we were up 22 cents today. The December corn price is literally changing forecast to forecast. People are following the rainfall maps in the Midwest and saying, oh, it missed this part of Iowa, it got this part of Indiana. We have too little rain here. We have too much rain there. What does next week's forecast look like? And the corn market's been kind of on a wild ride as a function of that. When we look at what that means for dairy farmer costs, when we use the USDA DMC model, we peak out at something that's over $12 per hundredweight here in terms of feed cost. It gets a little bit better as we go down the curve, but it's still way up above anything we've seen over the past several years. And that definitely has an impact on farm margins. For 2021, when we use the same DMC measurement, we're showing 742, which is down 12% on a year-over-year basis. So we have lots of milk, lots of cheese, or we have lots of cows and lots of milk, and we also have lots of cheese, which is material to this conversation. We have strong milk production, and we have new cheddar capacity. We have a new cheese plant in Michigan that's taking in 8 million pounds of milk per day. There's a couple other expansion projects that are unfolding. And so we have abundant cheddar output. January through April, cheddar production was up 5% year over year versus the same period in 2020. May CME spot volume was the heaviest since 2018. And year to date, we're up 34% in terms of volume from where we were a year ago. And so more cows, more milk, more cheddar has been weighing on the price of cheese here lately. We don't really have a demand problem. Actually, demand has been pretty good, especially at retail. Cheese and butter retail sales were down. They've been down versus last year's sort of grocery market craziness, but still pretty well ahead of 2019 levels. If you look at cheese, running somewhere between 8 and 10% higher versus 2019, even though we're lower than last year. And butter, the margin versus 19 has been a little bit lower, but still outperforming those numbers. So in-home retail consumption of cheese and butter has been quite solid. We do have an issue with fluid milk sales. They now account for only 20.5% of U.S. milk production, down from 34% in 2002. Year to date, sales through April are down 5%. And just keep in mind that lost volume is enough to make about 100 truckloads of extra cheese per week. And so we did have a little bit of a moment where fluid sales year to date through April anyway improved last year as the pandemic unfolded, but we are back to sliding. The retail numbers I've seen recently show that we are down 7 or 8% versus last year and down 8 or 9% versus 2019. So while the overall demand story is positive, it's still being driven by cheese and butter, and the fluid side is giving back, if you will. Export-wise, I think the export picture is mixed. We had record cheese exports in April with about 90 million pounds shipping. We likely have some opportunities again with the spot market lower than 150 on cheese. The butter market, if you look at this middle graph, the price of butter in New Zealand at GDT went kind of crazy, and the European price went higher too, while we were going lower. So this created some export opportunities for the U.S. down in here. Now this gap has closed quite a bit. So butter had a good run on exports, but that seems to be over. And I think one thing that we could, we don't have time to get into much detail today, but it's worth pointing out, is that quietly, almost behind the scenes, China's appetites for milk powders have been pretty intense. And you can see here for the first 5 months of the year, imports of skim milk powder and whole milk powder are actually above where they were in 2014, which was sort of the semi-famous China loading up on powders moment. And so one of the reasons that our milk powder market has found at least a modicum of support has been global export picture has been good for milk powders into China and elsewhere in Asia. But I would say that overall, the export, we are sort of competitive on cheese on a spot basis, not really on a futures basis. Our butter moment may have passed. Milk powders still seem to be pretty healthy. I just wanted to spend a moment talking about risk management. Dairy farmers, I think it's fair to say today, have access to better risk management tools than they've ever had. The dairy margin coverage program, which we see as sort of being ideal for farms up to about 225 cows. Enrollment last year was only 38%, but it's back up to 60% this year. So a lot of smaller farms enrolled in DMC. And when you look at a feed cost of, call it $11 per hundredweight, as it's been here lately, when you look at the 950 coverage level of DMC, that's equivalent to having basically a $20.50 put option on milk income, which is not a bad put to have against limited volume, admittedly. The Dairy Revenue Protection Program, DRP, which is part of the federal crop insurance program, remains popular. It appears that about 20% of U.S. milk production is under coverage in 2021 under that program. A little less than last year, but still pretty strong. We do see CME futures and options volume down fairly substantially year to date through May. So I think that some of this DRP action is cutting into maybe cutting into the CME prices, and there's certainly been less volatility than we had a year ago. So that might be a reason why volumes are down. Okay. Let's talk a little bit about the demand picture and some of the larger macro trends that we're following. Just a reminder, if you do have questions, enter them into the chat and we will inventory those for answering them in a little bit. Gary, in his intro remarks, alluded to massive disruption in supply chains and the whole upending of the food service industry as a function of the pandemic. And so I think I want to add a little bit of color of where we've been and where we are and where we're going in terms of this very critical demand dynamic in the marketplace. Before 2020, this should be before 2020, not before 2000, my apologies, restaurant dollars more or less had matched grocery dollars in the United States in terms of our spending. We were spending about as much in grocery stores as we were in restaurants. And those of you who've seen me speak before have seen this slide many times, and I apologize if you're tired of it, but it's still relevant. This is my don't ever underestimate the laziness of the American consumer slide. This was a joint promotion between Lazy Boy, McDonald's, and Uber Eats. This promotion happened before the pandemic. The premise was sit on this fancy Lazy Boy that you could win, push a few buttons, and Uber Eats will bring you some McDonald's. And I'm not sure that was especially cutting edge in the fall of 2019, but it seemed absolutely vital by the spring of 2020, when we were in the grips of a pandemic. And so I still think everything we see speaks to this, and I will argue that the pandemic accelerated everything. So in terms of where we are, in terms of restaurants versus food service, food service versus grocery, well, what do you know? Last year, as the pandemic started to have its grip on America and we had these massive shutdowns, food service sales tanked, and meanwhile, grocery stores spiked. But you can see subsequently, the food service sales have been kind of coming back, and now the gap is only $7 billion in May versus year prior levels. And you can see restaurants, behind, and now restaurants above last year's levels. So look, we had to go to the grocery store. We had to eat at home more. We did it. I'm not sure we loved it, because now that we can go back out, we are going back out. And something I've talked about before, just this still works. What I call the stay-at-home trade is still working. If you look at stock performance over a 5-year period, the winners are still Netflix and Amazon and Domino's Pizza, which we don't have to leave our home to have a pizza appear in our laps, push 4 buttons and it's there. Home Depot doing quite well because we've tricked out our personal spaces, because we want, not only do we want to be at home or can we be at home, we've had to be at home for the past year. And so these trends are still very much in play. And really, it's all about convenience. It's sort of the inverse of saying that we're lazy, is that we can talk about how we love convenience, right? And I've been fascinated by watching Wingstop, their sales. And you can see before the pandemic, you could see digital sales creeping higher sequentially as we got better technology and better delivery services. But then once we got to the pandemic, these digital sales shifted into high gear. And so what will be interesting to see is, so now Wingstop in the first quarter of this year, 64% of sales were digital and 36% of sales were other. Do we ever roll back to where those in-person sales at Wingstop are even 50%? I doubt it. And then you look at quick service restaurants, which they've done well with pickup and delivery and also have drive-through windows. QSR sales versus 2019 have been quite strong. And when you look at the grocery space, you can see that click and collect, ship to home and click and collect delivery pickup type services, they faded off here in May as we get fewer restrictions, as the pandemic retreats some. But the May 2021 pickup delivery was still up more than 4x versus August of 2019. And I think this is interesting from a human behavior perspective, but I also think it's worth talking about there's 2 dimensions worth talking about from a dairy market's perspective. First of all, as we think about innovation in the space, as we think about what products should we be focusing on, what investments should we be making, I would say that if convenience is not part of the equation, it's probably not worth doing, or you need to figure out a way to enhance or embellish convenience as a function, as a factor of the whole package. Because clearly the trends were favoring convenience before the pandemic has only accelerated it. And while I think we'll see some of these things roll back, I don't think they're going to roll back all the way now that we've gotten used to some of these very convenient services and products. The second thing is, and we've talked about this a little bit before the pandemic, but I think it's especially true now, is that for years we've talked about perishability, and perishability is always sort of an Achilles heel or a factor to consider for dairy. But now I think we've really got to focus on portability as well as perishability. Because when you look at all this click and collect type restaurant business, so much of our food is now traveling from some sort of restaurant or commissary, to our home. On our podcast, we interviewed a development chef for Bloomin' Brands, the people who do Outback Steakhouse, Fleming's, and a few other concepts. And she told us that in their design kitchens, or their development kitchens now, they are figuring that you have to have a product that stands up for 45 minutes between the time it leaves the kitchen of a restaurant to the time it hits a table at a consumer. And so I think the question for dairy is, how do we make sure that our products, or how do we elevate the portability of our products? How do we make sure that we focus on what's portable and what works? Because if we are going to remain in this convenience mode, in this pickup, delivery, click and collect mode, I do think that we don't want our products to be labeled as being non-portable or less portable than other products, because we want to be in the portability game. And I think part of this whole story is working from home is going to continue into 2021 and beyond. We are seeing more people go back to the office. And I think that maybe some of the tough talk about how I'll never leave my basement might fade now that you have the opportunity to do so. But I do think that we are going to see more people working from home in the months and years ahead. And I think that has a couple of different implications. One of them is around stuff like lunch. What happens to going out to lunch in a world where we're not going to the office? Is lunch dead? Or is lunch going to be something different? And then the other thing it has to do with is around where we live. I think as a function of working from home or working from anywhere, our policy at blumlinganddairy.com is work from where you work best. For some people, that means a second home someplace. For some people, it means in the country. For some people, it means in an RV. One of my favorite stats that I've been following is RV sales, up 84% year to date through May. Companies like Airstream have a new trailer that comes with beds that transform into a home office. And so I think we are just in the early innings of this trend where people are going to say, oh, I don't have to live downtown here to go to an office every day. I can live in the suburbs, the exurban, or in my RV. And what does that do for the restaurant industry, the grocery industry, and how we pick where we get food, where we eat food going forward? In terms of the overall economy, just a couple of comments. We have seen significant government stimulus. I think that one of the lessons learned from the 2008-2009 financial crisis was go big or go home. And I think that the U.S. government across two administrations now and Congress has provided massive they realized this and provided massive stimulus to help consumers and the economy make it through the pandemic. More than $5 trillion in unemployment and transfer payments in March of this year alone. That's the stimulus. SNAP enrollment back to multi-year highs with record benefit levels. And so there is a lot of government money in the system, which I think has certainly been favorable towards demand. At the same time, consumer debt is not really all that burdensome. I think we saw the consumer being in relatively good financial position ahead of the pandemic. If you look at credit card debt, it trailed off after the financial crisis, rose, but really, relative to incomes wasn't all that bad ahead of the pandemic. And during the pandemic, we paid down credit card debt. When you look at mortgage debt outstanding, that's been going up, but at a rate, it's reasonable historically. And debt service as a percentage of disposable income, those numbers are well under control. So I think that credit card debt was down 14% in Q1 versus the same period in 2020. So I just think that the consumer's balance sheet, again, now it's dangerous to traffic in generalities. This is not every consumer in every income bracket in every locale in the United States, but as a general statement, the consumer balance sheet is in pretty good shape as we get to the second part of 2021. Part of that healthy consumer balance sheet has been we've been buying stuff, and the transportation business is a mess. When you look at freight rates, they're at all-time highs. We have major capacity issues in the space with labor, lagging truck orders, all kinds of issues. Global shipping rates are extremely high. And so we do have a logistics problem at the moment. And this does ultimately filter its back way into commodity prices. When it costs 4 or 5 cents more per pound to move cheese from Idaho to Wisconsin, and then from Wisconsin to the East Coast or whatever, someone's paying for that, and that tends to come out of the commodity price to some degree. And exports have been part of one of our challenges in the export market right now is that we have a lot of empty containers leaving the United States at very high freight rates, and so that's a challenge. So this freight situation bears watching. It's a function of our relatively good economic performance. It's a drag at some point. And we don't think it's going to get fixed, anytime. This is not likely to be fixed by year end. Just in terms of other macro indicators, I think one of the things we think about when we think about dairy demand and dining out, we think about business dinners, right? I mean, we're not in Lake Tahoe this week. There are business dinners that are not being had as a part of CCOA. And of course, we could extrapolate that over any number of meetings, at least through the first half of the year. We'll see more during the second half of the year. But we do see hotel occupancy rates rising, and this is mostly leisure. We do see TSA checkpoint traffic up above pre-pandemic levels finally. So, we are flying a little bit more, but again, more leisure travel than business travel. We do have some big holes in leisure and hospitality employment. So I do think that this area is on the comeback trail, and it is a semi-critical or certainly an important piece of the dairy demand puzzle, because when we start going back to places like Chicago and start going back to restaurants, business dinner type restaurants, that's an area that needs a boost. I don't think I need to tell most people this. Real estate is hot. Sales of existing newly constructed homes at multi-year highs. Interest rates are low and likely to remain low. All kinds of stories about multiple offers and above ask pricing. And so this has been an area of strength for the consumer balance sheet as well. But the cost of housing is going up. When we look at the energy story, we see blessings and curses. Crude oil prices are starting to perk up. Exploration remains way down. The rig count well below 18-19 levels. And so theoretically, we could produce more oil here in the United States, but it's going to take a while. Unemployment in the energy and mining sector is about 10%. But gasoline prices overall, while we're well above last year's levels, still pretty moderate. $75 crude oil, higher certainly than where we were last year at this point in time, but not out of control. So energy helps employment on one side. When we are drilling and exploring in the U.S., it's an employment benefit. Higher prices for oil. So higher prices for oil are theoretically good to encourage that employment. On the other hand, higher prices for oil mean higher prices for gasoline, which takes disposable discretionary income out of consumer pockets. A lot of talk about inflation, with Fed funds rate near zero and not likely to move up. There's been some money chasing commodities, but some of these markets seem like they're past their peak. I've been following the lumber story for a variety of reasons. Lumber futures got to a high of $1,700 per thousand board feet at the peak in early May. Normal lumber prices are about $300 to $400 per thousand board feet. So, but this market is down 40% from the highs. So I think that some of these commodity stories might be a little bit late stage or maybe on pause. The U.S. dollar has actually been strengthening over the past few weeks, which also hurts the buy commodity story a little bit. That said, I was fascinated to see this graph on the right in the Wall Street Journal a couple of weeks ago. It's a general retail inventory number, but you can see that over several years, as we kind of went just in time type inventories, our buffer stocks of things were lower, maybe a little bit firmer. But then after the pandemic, a spike higher in inventories. And now look at how far behind we are on this measure of inventories. And while this might be just clothing or, sporting goods, this is not necessarily cheese or butter for sure. But I do think that this says that we've got a lot of pipelines to fill in terms of demand, right? If you drive past any auto dealer, at least here in Madison, Wisconsin, their lots are nearly empty. And so there is pent-up demand. There are still supply chain issues out there that are restraining supply. And so when you have latent, powerful demand, choked off supply, that is a recipe for higher prices somewhere, somehow. And the other thing, too, that always makes these commodity and inflation stories fun, the story does have some China angles, meaning China's appetites for corn have been immense. China's appetites for soybeans have been pretty strong. China's appetite for milk powders, as previously discussed. And so whenever you can string together weak dollar, prolific government spending, and China doing this or that, you usually do have a good commodity type story. And that is it for my prepared remarks today. I encourage you to check out a podcast that Kathleen Wolfley and I do in concert with the International Dairy Foods Association every other week. We have fun with it. We have some interesting guests. Check it out on your favorite podcasting platform if you have time. So I do have a couple of questions I see here in the queue. But would invite you to, I think we have a few minutes for a couple more, but I will answer the two that I see in front of me. The first was relative to, I think it was relative to the fat content the higher fat tests? And do we have this type of data on size of farm? We don't. USD, we don't. I suppose we can kind of go into some of the dairy.com type data and see. But I'm guessing, just based on the farms, the producers that I speak with, I think we've seen many more large-scale conversions into jerseys. We see a huge investment and emphasis in genetics and genomics in some of these farms. And so I would be really, really surprised if the big farms were not leading the parade on this component testing stuff, the higher component levels, higher fat levels. It's going to be interesting to see, because I think we are starting to get questions from our clients around, hey, are there ways that we can kind of discourage the fat a little bit and encourage the protein? The second question concerns China. I mentioned the strong powder sales, but do you think there are opportunities for other dairy sales and exports, milks, ice creams, yogurts, etc.? Yeah, I think that with China, it's so hard because you don't know what's real and what's not real, what to believe or not believe. Because here's what the data tells us about China. Milk production in China is up sharply, yet imports are up sharply, and dairy prices in China are high. So when you have strong imports, strong domestic production, and strong pricing, that can only mean one thing. It means that demand is really, really good. And I think that from what we can gather, there's been either an implicit or explicit conversation in China around how dairy boosts immunity. And that certainly has been a top of mind topic as the pandemic started and unfolded in China. So I think that the Chinese government has been promoting dairy for years. I think that there's a whole bunch of promotion around immunity claims and dairy, and that certainly boosted the dairy market demand profile in China. Now, the watch out is that the supply side in China has gotten bigger and bigger. I think milk production in China is up somewhere more than 5% year over year. So we are seeing some decent investments in infrastructure in China that are beginning to mature or beginning to yield fruit in terms of more milk production domestically. And so you have to be careful about where those lines start crossing. But to the question at hand, are there opportunities for other types of stuff, milks, ice cream mixes, yogurts, etc.? I would say, yeah. I think that they've been importing a lot of UHT milk, a lot of it from Australia because it's close. Now there's been a little bit of a trade tiff with Australia. So there's a lot of European UHT type milk coming into the country. So there's opportunity there. Ice cream, I've not really heard much about ice cream mix. Yogurt, I think, definitely has some legs. Cheese has been a mixed story. I think cheese runs into problems because it is not really being, I don't think the Chinese home is as ready for cheese, or the Chinese supply chain to get cheese into a home is not as robust as it is elsewhere in other countries. And from what we understand on cheese, there's a lot of process/imitation type cheese in that marketplace. Cold chain is an issue. So I'm not sure that cheese is a huge opportunity. I have mixed feelings about butterfat, but I do think that fluid products and yogurts definitely have an upside based on these immunity claims and based on the recent trends in country. So folks at Mission Control, those are the questions that have been submitted as I see them. I don't know if we give a last call for questions before moving on to our next speaker, a musical intermission or something else. But that's what I have today for you, and I really do appreciate your time and attention. Oh, here we go. Question, have any efficiencies been gained through the pandemic situation? I think kind of interestingly, there's sort of an almost reverse efficiency going on at the wholesale level. And so as that graph of retail inventory suggested, the U.S. had been in an extended period of just in time, just in time, just in time. And when the pandemic, kind of ripped through the system in March, April, and May of last year, and we had these massive shutdowns, we saw the real limitations of just in time in that pandemic environment, right? Because all of a sudden, people raided the grocery stores, and we didn't have any toilet paper, we didn't have all kinds of different products we ran out of. And so, the just-in-time movement has been historically a quest to gain efficiency and squeeze extra dollars out of the system. And yet we found ourselves short. And I would argue that today, I don't know that just-in-time is dead, because eventually I think we'll go back and try to capture some savings. But from anecdotally hearing from our clients, they believe that food service distributors, other CPG companies, they have been actually intent on having a little bit extra on hand relative to where they were pre-pandemic. And so there's a whole dynamic of, we don't want to get fooled again, or we don't want to get caught short again. And so in a very tangible way, and a very interesting way at the wholesale level, we've seen the opposite of efficiency, in that the movement towards just in time has reversed, at least for now. Now, again, we're going to get to a point where we're some accountant somewhere says, my gosh, look at how much it costs us to carry this inventory. The consumer isn't willing to pay for that. What are we going to do? Let's get rid of, and we're going to kind of slim things down again. But I would guess that the fear of not having enough has been a real issue. When we talk to our clients, it's really interesting. The only thing worse than paying too much for something is not having enough, or not having it at all. And so I do think that we've seen a little bit of a bulking up on the inventory side. Now, elsewhere in terms of efficiencies, I'm guessing that we've got to be figuring out ways to squeeze miles out of the system, just given how transportation costs have increased. I think with a new cheese plant in the center of the U.S., we're going to see some rerouting of supply chains and customer patterns in a way that means we're moving less cheese from the West to the Midwest, because there's more local cheese in the Midwest these days. So I think we're going to see that. When it comes to the farm, I just think that when you talk about milk per cow, that's efficiency, right? That's all about gaining efficiency. And when we talk to our clients on the farm side, they are amazed at the advances in some of the on-farm housing and what that yields versus even 10 years ago. These big cross-vent barns, I guess, are really, really incredible in terms of boosting efficiency. We have some dairy farmers who say that stuff they built 5, 7, 10 years ago isn't even close to being as good from a labor and milk comfort, cow comfort, and milk productivity angle as some of these big cross-vent barns. And then lastly, I would say that we see dairy producers making significant investments in genetics. And isn't that all about, at the end of the day, more efficiency? Getting more from the cow, featuring the best genetic traits in genomics, and pushing that milk productivity envelope as far as we can. And I just think we're still in the early stages of seeing what that can yield. I think we have time for one more question if it's a quick one, but I think we have 1 minute left as best I can tell. All right. Well, I think we are close to the top of the hour, and our time today being done. Again, I want to thank thank the folks at CCOA for having me. And the next session will begin promptly at 11 a.m. Pacific time, which is in just seconds from now. So this is Plourd again. Thank you very much, and enjoy the rest of the conference.